Welcome back, guys. We're busy with adjustments. Remember, we said important. Whenever you're dealing with adjustments, remember, accrued income plus deferred income minus accrued expenses plus prepaid expenses minus. What am I referring to? I'm referring to the operation that you're going to show in the bracket. And then obviously consumable stores on hand minus or depending on the information that's given to you. Right, let's look at this adjustment now. Stock taking on the 28th of February reflected trading stock to be 1,234,800. Step number one, go and find out, did you have any further adjustments on stock? Yes, we had. There was a stock returned of 7,800. We've already done that calculation. And there was stock stolen to the value of 37,500. We've done that calculation as well. Okay, this means therefore, if you look at your trading stock figure, let's identify it from my balance sheet. Here we go, 1,287,000. Okay, so I take my 1,287,000 as my starting point, add the stock that was returned by the consumer, less the stock that was stolen, the 37,500, less what was my stock figure as per my stock take. Here we go. As per my stock take, my final stock figure was 1,234,800. There we go. And therefore, you find that that is your final stock figure as per your physical inventory. Meaning, if you look at it, if you do the calculation, you find that there's a shortage of 22,500. In other words, if you want to, let me just show you the trading stock account as a T account. Opening balance, 1,287,000 is your opening balance. Add the 7,800, less the 37,500 that was stolen, and your closing balance has to be 1,234,800. Okay, so if that's the information that you have, you find that the missing figure will be what? Watch this here. Let's do the calculation so we can see it. 1,287,000, right? Plus 7,800 minus 37,500 minus 1,234,800, and there you go, 22,500 clearly is your missing figure, meaning you have an entry for what? Trading stock deficit, a debit of 22,500 and a credit to your trading stock of 22,500. Now watch this, guys, important. There's my calculation. I've also showed it to you in the form of a T account. The same thing, 1,287 plus 78 minus 37,500 minus the closing balance will give you your trading stock that you've identified, the trading stock deficit to be 22,500. All right, so summarize that. Opening balance of your trading stock. Look at any other adjustments that you have on stock, then compare it to your final balance to either give you a trading stock deficit or a trading stock surplus. Okay, let's move on to the next adjustment. It says here, provision for bad debts was 10,200. That was your opening balance, right? Provision for bad debts must be decreased to 9,700. Once again, watch this here. Simplest way of doing it, your current provision is 10,200, right? We know that provision for bad debts is a negative asset with a credit balance. What must your new provision be? Your new provision must be 9,700. Clearly you can see that if your new provision is 9,700, meaning that if you take that figure, let's do that, 10,200 minus the 9,700, clearly you can see that in order for this to happen, you need to debit your provision for bad debts with 500 Rand, and you're going to credit an account called provision for bad debts adjustment. So when we are decreasing the provision for bad debts, watch here. There we go. Provision for bad debts is 10,200, must now become 9,700. We are decreasing it, meaning that your provision for bad debts adjustment, when you are decreasing your provision, it becomes an income. When you are increasing your provision for bad debts, it becomes an expense. Which account? The adjustment account. Okay, remember, provision for bad debts is a negative asset. Why? It reduces the balance of your debtors. So it's debtors less provision for bad debts will give you net trade debtors. In our particular example, we are decreasing the provision. Therefore, the 500 Rand becomes an income amount under our other income provision for bad debts adjustment. How much? 500 Rand. Okay, next one. Okay, the next adjustment that we have, we are told the rent for February 2019, here we go. The rent for February 2019 was still outstanding. Right, so immediately we know that we are dealing with an outstanding amount. What do we look at? We look at the fact that it's a rent. Let's identify the account. It's your rent income, right? And this means that you are looking at accrued income because the rent is still outstanding. Immediately you know, because it's an accrued income, let's make a note of this, because it's an accrued income, immediately what's going to happen is in my bracket, I'm going to have a plus sign, and that is linked to the accrued income. Okay, so that's step number one. Now we're going to do the actual calculation. So we identify rent income as 158,200. Let's do that. So we say, fine, let's take the old rental to be 100% because we don't know. All that we know is that rent was increased by 10% on the 1st of November. Okay, meaning therefore, let the old rental be 100 for how many months? 8 months. Why 8 months? From the beginning of your financial year, which started in March. So here we go. It's March, April, May, June, July, August, September, right? And the rent was increased. Let's just get the date right. The rent was increased on the 1st of November. So September and October. If you count this, it gives you 1, 2, 3, 4, 5, 6, 7, 8. So these 8 months represents the old rental to be 100. So multiply 100 by 8 to give you 800. Then your rental was increased by 10%. Therefore, watch this here. 100 plus the 10% will give you the 110 we want for our new rental. And it was only received for 3 months. How do we know that? Because we are told in our adjustment that the rental was still outstanding for February. That means you have received rental for how many months? The new rental was November, December, and January. Therefore, 110. So that will be your November, December, and January. Can you see the 3 months? There we go. There's the 3 months. Multiply that by 110 times 3 will give you 330. Now watch. Add that component. The 800 plus the 330 will give you 1,130, which is equal to the rent amount which we've established to be 158,200. There we go. There's the 158,200. So in terms of percentages, the 1130 is equal to the rand value of 158,200. What are we looking for? We're looking for the 1 month, which is the February month, which is outstanding here, right? And the February, you can clearly see, is 110 month. Therefore, 110 is equal to my unknown. Cross multiply 158,200. Let's do this calculation together. Here we go. 158,200, which was my rental figure, times 110 divided by 1130, and there we go. We have our figure of 15,400. What is the 15,400? That is your accrued income for rental. Now, in terms of my layout, watch, this is what I do. I start off with the 158,200, once again, identifying it from my pre-adjustment trial balance, 158,200. And remember what we said, there's that operation, important, very important, that is as a result of accrued income. So plus the 15,400, which was my calculation, which we just went through to give me a final figure of 173,600. Okay, let's summarize this rent entry. Step number 1, make your old rental be equal to 100. Then you either increase it if there was an increase, or you decrease it if there was a decrease. In this particular example, there's an increase of 10%. Determine, ascertain how many months were subjected to the old percentage, namely the 100. In our case, it was 8 months, therefore 100 times 8 to give me the 800. Then your new months, 110 for 3 months, add the two percentages, equate that to the rand value, and find your missing figure. Most important, it was an accrued income, therefore my operation is a plus. In my bracket, as you can see, there we go. There's my bracket, 158,200 from the trial balance. So that's your trial balance figure. There's your adjustment. And what was my adjustment? An accrued income. A debit to accrued income, a credit to rent income. Once again, let me illustrate to you why a plus. Here's my rent income. Right? It's an income account with a credit balance of 158,200. That's the figure. Double entry, debit accrued income. Here we go. There's my accrued income. Debit it with 15,400 because it's a temporary asset. A credit to rent income of 15,400. Here you can see the fact that it's on the same side means you got to add that. Clearly indicates to you that your new figure is 173,600, and that's the figure that will appear in my statement of comprehensive income. Okay, let's look at the next adjustment. It says here, calculate the interest expense. Right, how are we going to do? We're going to start off with our balance at the beginning of the year, which is 2,620,000. Repayments during the year, including interest, was 510,000. The interest capitalized is my unknown, and my closing balance is 2,398,200. The easiest way of doing this, guys, is to have your loan account. Step number 1, loan account, opening balance. Notice you don't need any details, just the figure, 2,620,000. Step number 2, repayments. That actually is your bank figure. Again, this is just extra, but the fact that it's on the credit side indicates that you've paid and therefore you bring in your payments. Step number 3 is your closing balance. Bring in your closing balance of 2,398,200. All that you now do is you take your figures of 2,398,200 plus 510,000 is equal to that, minus your opening balance 2,620,123, and voila, there we go. What do we have? 288,200 as the interest that is capitalized. Watch. Here's my calculation once again. 2,398,200. There. I'm showing you exactly what we're doing. Add the 510,000 minus the 2,620,000, and there we go. There's my closing balance for my loan, for the interest on my loan rather, to be an amount of 288,200. Okay, so when you're dealing with the loan, step number 1, opening balance. Step number 2, your bank, your repayments, the total amount. Step number 3, bring in your closing balance. Once you've done all of that, your missing figure will be your interest expense, right? What's the double entry for the interest expense? A debit to interest expense and a credit to your loan account. Let's look at it. Here we go. There we can see it. A debit to interest expense, a credit to my loan account, 288,200. So in other words, your interest expense for the year amounts to 288,200. Recap on the loan: opening balance, closing balance, bank repayments, to find your missing figure, namely your interest expense. The fact that interest is capitalized means you're debiting interest expense and you're crediting the loan account. When we say capitalizing the interest, it means that the interest goes back into the loan account. Let's take a quick breather, guys. When you come back, we continue with the adjustments.